All right, hello everyone, and welcome to a video which is similar to a series we did last year, which was poorly answered exam questions in the 2019 exam. We're going to be doing poorly answered questions in the 2020 exam. We already did an exam breakdown of the whole 2020 exam, but that was before the examiner's report came out. So now we have the data of what questions were done well, which questions were not done well. We're going to focus on a few of the main ones that were done poorly, that being 2 multiple choice questions and 3 parts of question 2, which question 2 was unanimously done some of the worst on the exam. You might notice I'm in a different setting to normal. Normally I'd be in my office, but I am in a classroom. So you get that authentic school feel. Apologies, I don't have my drawing tablet or fancy microphones. The sound might be a little bit off compared to normal. A little bit less highlighting and stuff, or if it looks a little bit dodgy, it's because I'm doing it with the trackpad. So let's get straight into it. So question 13 of the 2020 exam was done a little bit poorly, and it's mainly because students were unsure of exactly what was in an underlying cash surplus, because basically it hadn't been asked about specifically before. Something you learned about all the time along the way. Most of the time we just talked about budget deficits and surpluses in the exam and didn't have to talk about the underlying or headline balance specifically. So when it asked what was the size of the underlying cash surplus, I believe it was something like 47% of, oh, this was even less. This was a very, very small percentage of students got it right. It was about 13% of students got this right. So when you need to work out the underlying cash surplus, what you need to do is it's the total receipts minus outlays minus any net cash flows from investments and future funds earnings. Essentially what it's doing is taking away anything that would overstate the government's financial position. So future funds earnings aren't actually, basically what we're trying to find out with the budget balance is the balance of overall and revenue coming in for the government via taxation and what's going out through expenditure. And cash flows from investments isn't a revenue from tax, etc. So it would overstate that. And future funds earnings are the same. It's from their investments. They want to know how much they're getting from taxation and how much is going out for that budget, like the underlying cash surplus. So in this case, it was 200 minus everything, and you got to 10 billion. A lot of students kind of like did receipts minus outlays and then kind of like tried to play with what else to take away or add on, and it got a little bit tricky for them. But simply just receipts, take away everything else. I have a feeling if they'll ask about this year, it might just be in short answer to kind of differentiate a bit, knowing that students did it poorly, but not asking it in the exact same way. They could just ask about it in the exact same way. They've asked the same inflation question in multiple choice like 3 times in the study design, so I wouldn't put it past them. And then question 15. Which of the following is most likely to cause cost inflation? So we've got these, and so the important part being cost inflation being supply side. So which of these is going to increase cost of production or decrease efficiency for businesses and cause cost inflation? So excess demand for goods and services, we can rule that out straight away because that's demand side, that's demand pull inflation. The government reducing company tax rates, that would lower the cost of production for businesses and therefore not lead to cost inflation. Expectations by employers that interest rates will fall, well, that's not going to increase cost inflation because their cost of production is the same interest rates are the same, and they think they'll get lower in future, so they're more likely to invest in future. So that's got nothing to do with cost inflation. So we get to what about 47% of students got correct is an increase in superannuation contributions paid by employers, and the paid by employers is the important part there, because that means that's increasing their cost of production, and that's going to lead to that increase in cost of inflation. So that's really, really important. So yeah, only about half students got that right, and it was really, really simple to get right if you knew the correct logic. Now again, just a short answer. So I'm going to go with 2A first. This one should be a relatively simple question. I think it's a question a lot of students probably came out of the exam feeling confident about, but when they then looked at the examiner's report later, which I assume almost none of the students that sat the exam actually look at the examiner's report, but we do in the future, describe 2 economic reasons why the Australian government might find it difficult to achieve a budget surplus in the short to medium term. And so a lot of students struggled with 2 distinctly separate reasons. A lot of students kind of described 2 reasons that sounded almost the same or had the same impacts. And so the main issue is students struggled with that. COVID was fine for both, but if you talk about COVID of both, you talk about COVID's impact on outlays. So discretionary outlays through infrastructure projects, job seeker, JobKeeper, etc. And also COVID's impact on revenue. So the decrease in taxation revenue from both households and businesses would be really, really significant and separate reasons. That would be 2 great ones to talk about to get more marks than the average, which is 2 out of 4, whereas 4 out of 4 was totally achievable. Some students also confused a budget surplus with the current account surplus, which I've noticed a lot happening this year. They're not the same. Budget is all about tax and government outlays. Current accounts are all about money coming into and out of Australia. Totally different. And because it's short to medium term, the level of government debt wasn't really acceptable to use because we don't have to pay off that debt in the short to medium term. The growing interest burden, however, is relevant. So the more and more debt that we have from going into these deficits, we have to pay off more interest each year, and therefore it's harder to return to surplus because we've got more of an interest burden to repay each year. And so that's relevant, but in the short to medium term, the level of debt isn't, because you aren't paying that debt off. That's a long-term structural issue. So in short and medium term, only interest is what we're worrying about. So the sample answer that came from VCE looks like this. So the government may struggle to achieve budget surplus due to falling levels of economic activity across the nation due to the ongoing COVID pandemic. Really clear reason straight away. Given that some industries will not recover for many years, such as aviation, the budget outcomes likely to deteriorate due to automatic stabilizers. So once again, being really clear about that. Giving an example of an industry, also great. This refers to changes in budget outcome which occur automatically in response to changing levels of economic activity. Low levels of economic activity reduces company profits and income levels, reducing the receipts of a company and company tax, thus worsening the government revenue. This is particularly evident in 2020 due to the COVID-19 pandemic, due to ongoing lockdowns, making it more difficult to achieve a budget surplus in the short to medium term. A second reason the government may find it difficult to achieve a surplus in the near future is the significant outlays expended on discretionary stabilizers. Refer to a little bit, changes, etc. Significant costs such as JobKeeper and the asset write-off scheme make it hard for the government to consolidate finances due to significant stimulus measures to support the collapse in aggregate demand during the COVID pandemic. This is obviously way, you could write less than this and still get the full marks, but that's a massively detailed answer to give those the 2 marks each, but really clear reasons about why they might struggle in the short to medium term. And that short to medium term is what's really important there. Then we go on to 2B, about explaining the role of automatic stabilizers in influencing aggregate demand and stabilizing the business cycle in 2020. I found this one really interesting because actually, and going over it, I noticed a few more things I'm going to stress to my students before the exam next week now that they maybe might not do, or they need to think about doing more. So some of the major issues with this one were that saying welfare payments increase disposable income, when realistically, as people move onto them, it's just stopping their income from falling as much. They're going from their working income to a transfer income. So those automatic changes to getting on unemployment benefits work to stop income falling as much. Other issues that came up was people saying the government increased welfare payments, which makes it sound discretionary in nature. The government doesn't do that. It's automatically built in. That happens automatically. The government doesn't have to do anything. That's the specific point about automatic stabilizers. So it's about the value of welfare payments changing automatically. And some students also spent too much time talking about automatic stabilizers in all stages of the business cycle when only a downturn or trough is relevant. Because the question asked about in 2020, you have to make sure that answer relates back to the current events that are occurring. And so the important part being talking about what automatic stabilizers are, kind of saying where we would be in the business cycle, which in 2020 was in a downturn or a trough, and saying how automatic stabilizers then impact them there. Another thing I'd say that a lot of students have been missing out on throughout the year is that when you talk about automatic stabilizers, you should always talk about both welfare payments and the change in taxation revenue. A lot of students only talk about the change in increasing welfare outlays, but they don't talk about the decreasing tax revenue as people start becoming unemployed and businesses lose sales and people lose their income. So that's very important to talk about too, because those two things work to change the overall budget outcome into a way that's more stimulatory for the economy. So yeah, there we go. So then we're going to look at VCE's sample answer. So automatic stabilizers are components of the budget which vary in a generally countercyclical manner in correspondence to changes in the level of economic activity. As such, they occur independently of government decision making. During 2020, the COVID pandemic has led to unprecedented downturns in economic activity. Consequently, automatic stabilizers, or the cyclical component of the budget, have changed, helping to support economic activity. For instance, this downturn led to an increase in the unemployment rate from about 5% to approximately 7.5%, leading to an increase in the amount of Australians who are eligible to receive unemployment benefits. In addition, many income earners moved to a lower tax bracket, which reduced the tax liability to the government. That's what I'm saying about the importance of talking about both, because if you didn't do that, you'd lose a mark straight away. Both these factors help to protect disposable incomes or reduce the fall in incomes, important point as well, for a substantial portion of Australians, which had a favourable influence on both the consumption expenditure and aggregate demand. As a result, the recessionary trough of the business cycle is likely to be somewhat reduced, which stabilises the business cycle by countercyclically increasing injections relative to leakages in the economy, supporting aggregate demand and economic activity. So very, very important there. Then if you talked about this year would be really interesting in that you'd be talking about the fact that where the data is now, it's kind of like we are at a peak, essentially going towards a contraction because the economy bounced back so quickly, and then we had the Delta wave. You talk about the fact of unemployment being so low, economic growth and inflation being high by comparison, and how that would change in the opposite direction. Could be a very interesting question to talk about now. Then for our final question we're going to look at is question 2D, which is evaluate the effectiveness of monetary policy in 2020 in achieving the Australian government's domestic macroeconomic goal of full employment. So we're going to talk about a couple things with the question first, evaluate being strengths, weaknesses, and a conclusion. The effectiveness saying, has it done good or bad? Monetary policy being interest rates on the cash rate. In 2020 meaning having to link it to recent events. And achieving the government goal of full employment means you need to talk about that goal specifically and where basically it's been at. So some of the common errors occurred included no attempt to link a lower cash rate to lower interest rates. Obviously, that's very important. A lower cash rate doesn't actually affect households at all. The interest rates do. So mentioning the impact that has on financial institutions, probably pretty important. No attempt to demonstrate an understanding of the goal of full employment, defining it's probably a great idea. And then being able to link it, potentially even with being in 2020, knowing some unemployment stats would be great to include in an answer here. Simply describing how monetary policy was used over the course of 2020. That's not evaluating the effectiveness, that's just saying what happened. You probably get 1 mark. Unnecessarily spending time describing how the RBA reduced the cash rate during 2020. So you don't really need to talk about open market operations or the interest rate corridor, etc., or that fancy different monetary policy. You don't need to do that. Simply describing transmission mechanisms, channels of monetary policy. So although you could say that's how it works, you then need to link that into 2020 and full employment, how they go together. And then making no attempt to link the strength and weakness back to the goal of full employment. So you need to have a specific strength and weakness in monetary policy and then tie that back into the goal of full employment as well. So let's get into what VCA's answer was. So the goal of full employment refers to achieving a situation where everyone who wants a job is employed, as well as achieving the maximum rate of reduction in unemployment, including the elimination of cyclical unemployment, achievement of natural or NAIRU rate of unemployment of 4.5%. Given that the unemployment rate has remained well above this rate in 2020, it suggests that monetary policy has been ineffective. So that's they've done a little bit of an evaluation already because they've said ineffective. Despite having the inflationary first target, the current deflationary environment has allowed the RBA to instead focus on job growth and economic recovery, which is also relevant to this year, if you need to know that. However, due to the low levels of consumer confidence and high levels of household indebtedness, the very expansionary monetary policy setting of a cash rate of 0.1% has been largely ineffective, as the higher level of discretionary income of consumers has either been saved or used to repay debt, with relatively little being spent on the economy on goods and services, thereby having minimal impact on the demand for labour and unemployment. Due to the reduced effectiveness of the cash flow and cost of credit channels, the RBA has adopted less conventional methods, including quantitative easing, with the purchase of government bonds to further increase liquidity in the economy. This highlights the strength of monetary policy, as the RBA has the freedom and flexibility to do more than simply reduce the cash rate during a recession in an effort to boost employment and reduce the rate of unemployment. Overall, the economy has been experiencing negative economic growth and growing unemployment. It's clear that monetary policy has largely been ineffective in achieving full employment over 2020. In particular, in stark contrast to budgetary policy, it would not have been able to prevent the rate of unemployment climbing above 10% because it's relatively one-sided and blunt nature does not allow it to target specific areas of the economy, such as wage subsidies do for employers. So that's their answer. So they talked about unconventional monetary policy a little bit in their strength. You could also, if you haven't done unconventional monetary policy, I know I didn't do it with my classes because I thought that it's more important to focus on what is there. You talk about the short implementation lag. So the fact that when the cash rate was reduced in November of 2020, the change in interest rates for households can be done by the next day. it's implemented almost instantly and therefore can have an impact on households and businesses very, very quickly. That's when I then start talking about the fact of that means that businesses then have a lower cost of production very quickly, which increases their motivation to produce. If they want to produce more, it will increase the derived demand for labor, which will help create more employment and help us to achieve that goal of full employment. And that would be my strength in that instance. And so that's that question. And the average is 2.5 out of 6. So obviously, students did not do very well. And it's a very, very achievable evaluate question. That's been it for questions that were done poorly in the 2020 exam. Thank you for watching this. If there's anything else you want between now and next Thursday, which is the exam, let me know. I'll try and make it in time if I have time. I don't have many classes at school at the moment, so hopefully I'll be able to do the best that I can. Other than that, I hope you are doing well, and I'll see you next time. Bye.